A home equity loan is a way to borrow money using the value you've built in your home as security. Over time, homeowners accumulate equity as they pay down their mortgage and as the property's market value increases. Equity is simply the difference between what your home could sell for and what you owe on any loans tied to it. A home equity loan lets you tap into part of that equity in exchange for a new monthly payment. Because the loan is secured by your home, interest rates are often lower than rates on credit cards or other unsecured borrowing. The trade-off is that you're putting your house on the line, so the decision should be made carefully. Home equity borrowing commonly comes in two forms: a home equity loan and a home equity line of credit, often called a HELOC. A home equity loan typically gives you a lump sum up front with a fixed interest rate and a fixed monthly payment over a set term. A HELOC works more like a credit card, giving you a revolving credit limit that you can draw from, repay, and borrow again during a draw period. HELOCs often have variable interest rates, which means payments can change over time. People sometimes use home equity loan as a general phrase to include both, but the structure and risk are different, so it's important to know which one you're considering. The amount you can borrow depends largely on your combined loan-to-value ratio, sometimes abbreviated as CLTV. This compares the total of your existing mortgage balance plus the new home equity loan to your home's current value. Lenders typically want you to keep a portion of equity untouched to protect against market declines. If your home is worth $500,000 and you owe $300,000 on your mortgage, you have $200,000 in equity. If a lender will lend up to 80% of the home's value in total, the maximum combined debt would be $400,000. In that scenario, the maximum home equity loan might be $100,000 because $400,000 minus the existing $300,000 equals $100,000. The exact percentages vary based on lender guidelines, your credit, and economic conditions, but the concept is consistent. More equity and stronger finances usually mean a higher potential borrowing limit. Rates and payment stability are often a big reason people consider home equity loans. A fixed-rate home equity loan gives you a predictable payment, which can be comforting for budgeting. A HELOC's variable rate can be attractive when rates are low, but it introduces uncertainty. If interest rates rise, your minimum payment can rise too, even if your balance stays the same. Some HELOCs allow fixed-rate locks on part of the balance, but the terms vary. Before choosing a variable rate product, it's worth asking what the rate is tied to, what the margin is, how often it adjusts, and what the maximum possible rate could be. Those details determine your worst case payment. Repayment is another key difference between the two structures. With a home equity loan, payments usually begin immediately and include both principal and interest. Terms might range from 5 years to 20 years or more. With a HELOC, there's often a draw period, commonly around 5 to 10 years, where you can borrow and repay flexibly. During that draw period, minimum payments may be interest only. After the draw period, the HELOC switches to repayment, where borrowing stops and you repay principal and interest over a set number of years. That switch can create a payment shock, especially if you've only been paying interest. Many borrowers underestimate how much the payment can jump once repayment begins, so it's smart to model the payment under different interest rate scenarios. Homeowners use home equity loans for many purposes, and some uses are stronger than others. One of the most common is home improvement. Using equity to upgrade the home can be logical because the money is being invested back into the property, potentially increasing its value or improving your ability to enjoy it long term. Another common use is consolidating high interest debt. If you have credit card debt at a high rate, replacing it with a lower rate home equity loan could reduce interest costs and create a clear payoff schedule. But this strategy has a major risk. It converts unsecured debt into debt secured by your home. If you lose income or run into financial trouble, the consequences of missed payments are more severe. Consolidation also only works if the underlying spending behavior is addressed. Otherwise, you can end up with both the home equity loan and new credit card balances. Other uses include paying for education, covering medical expenses, funding a major life event, or making a large purchase. These can be reasonable in some situations, but they carry more risk if there isn't a clear long-term benefit. Borrowing against your home to pay for something that doesn't create lasting value can weaken your overall financial position. A home is often a household's biggest asset and a source of stability, so it's worth being conservative about using it as a piggy bank. Qualifying for a home equity loan often resembles qualifying for a mortgage. Lenders evaluate credit score, credit history, income, employment stability, and debt-to-income ratio. They want to see that you can handle the combined payments of your first mortgage plus the new loan, along with your other obligations. The lender also needs a reliable value for the home, often through an appraisal or an automated valuation model. If the home's value is uncertain or the market is declining, lenders may be more cautious about how much they will lend. Borrowers with strong credit and stable income typically qualify for better rates and more flexible terms. Fees and closing costs can vary significantly. Some lenders charge appraisal fees, origination fees, title fees, and recording fees. Some advertise no closing costs, but that may mean the costs are rolled into a higher rate, or there may be conditions such as keeping the loan open for a minimum period. HELOCs sometimes include annual fees, inactivity fees, or early termination fees. When you compare offers, ask for a full breakdown of costs and read the fine print about conditions. A slightly higher rate with low fees can sometimes be cheaper overall if you plan to pay the loan off quickly. Risk management is the most important part of deciding whether to use home equity. Because the loan is secured, falling behind can ultimately put your home at risk. Even if you've never missed a mortgage payment, adding a second payment increases your monthly obligations. If your job situation changes or unexpected expenses hit, the extra payment can become stressful. It's wise to keep an emergency fund, avoid borrowing up to the maximum you qualified for, and choose a term that fits your budget comfortably. Also consider how borrowing affects your flexibility. If you plan to sell the home soon, a home equity loan can reduce your net proceeds and make the sale more complicated. If home prices drop, borrowing too aggressively can leave you with limited equity, making refinancing or selling harder. It's also worth thinking about alternatives before you commit. Depending on your goals, a cash out refinance might offer a lower rate by rolling the equity borrowing into a single mortgage. It's also worth thinking about alternatives before you commit. Depending on your goals, a cash out refinance might offer a lower rate by rolling the equity borrowing into a single mortgage, though it can extend your repayment timeline and increase total interest. A personal loan avoids putting the home at risk, but often has a higher rate. A 0% balance transfer can be a temporary tool for debt payoff, but it requires discipline and a payoff plan. The best option depends on your credit, how long you need to repay, and the purpose of the funds. Home equity loans can be a powerful tool when used deliberately. They can lower borrowing costs, provide predictable repayment, and fund projects that improve your home or financial position. But they should be approached with respect because they tie your borrowing to the roof over your head. A good rule is to borrow only what you truly need. Keep your payment well within your comfort zone and use the funds for goals that strengthen your long-term stability rather than short-term spending.